What's up, niggas? I'm going over break even a little bit more in depth today. Just gonna be a break even video. It'll be a quick one. It's been a minute since we dropped the video, but we locked back in at my girl shit. Wanted to make a quick video for you guys. Let's get right into it, man. Break even stop loss. So, like I said before, when break even once an intermediate term high or low is hit or a fair value gap. An intermediate point of liquidity is hit, you move your stop to break even. Break even just simply means you have zero risk on the table. You break even. If it comes back to your position, you are losing zero, you're winning zero. Let me go over my play today that came back to break even. Okay, so oh fuck. Let's see right here. So my first play of the day was, where was it at, my nigga? Is my shit screen roll? Okay, bet. First play of the day was, it was the 30-second. Damn, bro. Where's that shit at? Damn, that was a nice move. My fault. Oh, it was right here. First play of the day was this 30-second long right here, which I saw that it swept a bunch of liquidity to the left side. We don't got to see that. But if you're in the Discord, you'll see my play. But so we got this 30-second inverse, right? 30-second inverse. So I entered early because even though you guys shouldn't be doing this, so I do not recommend doing this. I entered early before the candle closed above. So I entered somewhere around here at the close of the first candle. So I entered right here. I was targeting a untapped 15-minute gap in these equal highs up here. And I was targeting those. And so my target was basically this high right here, just to make it simple. It was basically this high, this significant high right here on the 1 minute. That was my target. And so I entered here. And if you could see my position, where do you think my stop would go to break even? I wouldn't, I deserve to get smacked for that dance, boy. Oh my goodness, I just saw myself in the corner of my screen, boy. That shit was hideous. Anyways, what do you think stop to go break even would be? Stop to break even would be this intermediate term high. So what that means is, so I see intermediate term high. Even though this is not my target, this is where my stop loss will get moved to break even, just like that, and I'll have no more risk on the table if it comes back down. So as you can see, it swept this high. And then as soon as it swept this high, I moved my stop loss to break even because you don't know at what point price wants to kind of retrace or reverse off of at what high. You don't know which high it wants to retrace or reverse from, because it could return at any point. It could reverse at any point. But that's why you have your bias, so you can have an idea. But so I moved my stop to break even once it hit this high, and then I re-entered at this point right here. And so for some more logic to why you do this is because if the market is truly bullish and it wants to target the area that you're targeting, and it wants to go to that point of liquidity that you're targeting, it should go there in a rush. It should go there in a hurry rather than be lethargic and slow and whatever. Like you get the point. And so once it takes this high, it should shoot to the next highs. It shouldn't stall and come back down. That's the point where there's a possibility, or there's potential that you are wrong with your idea and your bias is wrong. And so that's why I moved my stop to break even here. Look, let me give you guys an example. Let me go into replay mode. So I enter position right here, right? My idea is I'm gonna also go over stop losses in this video a little bit more in depth, so you guys have an idea, because I feel like I didn't go into in depth in the video. So my idea for this would be a violation of this inverse fair value gap would be my stop loss. So I would have my stop loss or my risk management system up to this point, 21,986. So if price closes below this fair value gap, which it should not close that much further below it, if it does violate it, I give it some room, a couple points like this, couple points, and then I enter, let's say I enter off 6 contracts right here, right? I don't really have a stop loss in because, like I said before, I use soft stop losses. So I don't have a stop loss in here, but I know if price closes below this green gap, then I will manually close my position. So I like what I do is what you guys will see me do. I'll hold my stop like all the way down here, even though this is not where I would get out of the market. In the market, I will get out if it closes below my inverse fair value gap. So my thought process is, okay, boom, let's go. All right, it sweeps that high, right? Since it swept that high, I'm moving my stop loss to break even because if it's truly bearish, it should continue up to my target without coming back down. It should not reject any highs. It should keep going up. So boom, boom. Okay, it looks like it's keep going up. It looks pretty bullish. It looks pretty bullish. Looks pretty bullish. Looks pretty bullish. Boom. If it's truly bullish, it should not be doing this. Okay, now I'm at the trade. Now I lost $0. Okay, this is where you don't want to chase a move. Just because you get stopped at a break even does not mean you have to instantly hop back in because you feel like you're going to get just because you're getting FOMO. That's when you become patient and look for another setup. That's when you see, okay, maybe I'll get maybe I'll get something else in a second. That's what I did, right? Okay, I'm like, okay, the market's stalling a little bit. Still hasn't hit my target though. Okay, that looks kind of clean. That looks kind of clean. That looks clean right there. That's when I'm like, okay. Was it this one that I entered off of? I think it was this one. I'm like, okay, if we inverse this gap right here, I'm going to enter, and I can enter even more contracts because the points that I'm missing is much less significant than this gap right here. As you can see, this gap that I'm going to enter off of right here is only about 4.5 points versus this gap is about 7 points. That's a lot less risk because remember it's $2 per point and then $2 per contract, right? So if there's 4.5 points, and my stop loss will go somewhere down here because I'm exiting at the violation of this inverse fair value gap. So if I'm risking about 6 points, right? If I'm risking about 6 points, that's $2 per point. So then you do 6 times 2, 12, and I risk about $200. So then you just do 200 divided by 12, which is about 12 like 14 contracts. So you enter like 14 contracts. 14 contracts here whenever it closes. Well, okay, still hasn't closed. Almost closed. Still hasn't closed. Oh, it closed. So now, boom, that's when I enter. Remember, soft stop. Soft stop. Your entry's right here. Exit is at the violation of the inverse fair value gap. Boom, I'm in there right now. So my stop loss would be if price comes back down and closes below the inverse fair value gap. So if we get a black candle down just like this, let's say it comes down. Hey, where's my shit at? Oh, my bad, y'all. Let's say I get a candle back down and it closes below my fair value gap, right? If it closes below this area, just like how my entry triggers once it closes above, my exit, if I'm wrong and I'm going to take a loss, is a close below. Not if it wicks. Not if it wicks down like this. Like this is a perfect example. Let's say this candle right here, this black candle came after my entry. I would still not close, even though it wicked below my inverse fair value gap. It still respected it. As you can see, that's a signature in price. It still respected this green box, this inverse fair value gap. So that's not an exit. I'm still in the trade if this were to come after this. Let's say there's a black candle came down, respected this area, and still did not close above, I'm still in until it closes below. If it closes a point below, 0.25, a tick below, doesn't matter, then I'm out. But since it has not, I'm still in. And in this case, where do you guys think my break even area would be? Remember the 2 points of liquidity, fair value gaps, and highs and lows. Pretty obvious in this situation. There's a high within the fair value gap, so it's even more of a hunch for break even, or more of an idea of a break even. So once this intermediate term high within this little fair value gap is taken, I am moving my stop loss to break even. So boom, okay, boom, I hit break even now because we hit this high and we entered this fair value gap. So instead of my stop loss being here now, I move it up to break even since we took out an area of liquidity, and there's a chance that market can reverse from these areas if the market wants to be bearish. But since I am bullish, I want to hold until my take profit, which was up here. And so, come on, my nigga. Why did it do that? Hold on, let me do this one more time. So my take profit was up here. Stop loss. Stop loss is at break. Oh, no. Stop loss is not at break even yet because we're still. Yo, come on, my nigga. What the fuck is this shit doing? Stop loss. Take profit. Okay, there we go. So boom, stop loss to break even. I'm gonna be posting a back testing session so I can show you guys the actual thought process. But here's just an example from today. And then, okay, boom, stop loss to break even. So I'm gonna have zero risk on the table. I'm risking no dollars. I'm in a free trade right now because I'm risking nothing. The only thing I could do is either win or make $0. Okay, now it took out this intermediate term high. I'm watching price to make sure it does not reject. It also violated this fair value gap right here, as you could see. Violated this fair value gap. So that's when you could add a contract. Let's say I could add one more contract up here, average in a little bit more. Average in a little bit more so I can make some more money. And it's still respecting, still respecting, still respecting. Okay, boom. And then once it takes that, my take profit, I'm all out. Dang, boom, just like that. That was the trade of the day today. You can see pretty clean price. You know, price has been pretty shitty recently, but this was a pretty clean setup today. But yeah. And then also another thing is, if let's say you have an let me see if I can find an example. Let's say I enter, okay, let's say I enter off of this inverse fair value gap right here. If we sorry, they're talking. Damn. Hold on. Oh, I'm tripping. My whole text is out there and shit. Anyways, just ignore the background noise. But let's say I enter off of this inverse fair value gap right here. Right? Let's just imagine this is inverse and this is my entry right here. Actually, that's a bad example, bro. Let's see if I can find a better entry. Let's see if I can find a better entry. If we form a intermediate term high while we are trading, then that you still move stop to break even. Let me try to find a fucking example, bro. Let's see if I can find an example. Oh, perfect. Oh, shit. Okay, boom, here, perfect. Like, let's see if I could do this. Okay, like, let's say this was an A plus setup, right? Let's say this was an A plus setup, this short right here. Like let's say there was a bigger gap within here, and the break even point was at this point at right here, right? Let's say you took a short off of the violation of this gap. There's a little gap right here, so just imagine the gap was a little bigger for a better setup example. Say I entered off this inverse, yet my break even point was right here. If we hold on 1 second. Can you guys are talking really loud. Can you guys just be quiet for a couple minutes? Thank you. Feel me though? That's how you feel me? But so let's say you entered right here. That's how you wear the fucking pants, my nigga. Fuck is you talking like? Quiet down. Hold on. Let me talk. Bro got that jet from you walk. Anyways, so let's say you enter off this inverse right here, like this short, and then yeah, this is your break even point right here, right? This is break even. This is, let's say your target is this low right here, but your intermediate term low is right here. So you enter right here. Let me go back a little bit more. Okay, boom, we just violated this tiny gap, even though I never recommend to enter off a gap this little, just make it seem like it's a little bit bigger. Okay, I just sold. See, I sell 10 contracts right here. Okay, I'm break even, and then my take profit would be here. Take profit here. Okay, boom. Let's see how this plays out. Okay, I'm about to hit. Oh, damn. Shit pulled back a little bit. Okay, you see how it forms a swing low while we're in the trade. A swing low right here because it's 3-candle formation. Remember, a higher low, a lower low, and a higher low, right? It forms a swing low. This will be your new break-even point right here. So once price comes down and retakes this low, then you move your price to break even. If it forms a kind of obvious swing low, you don't necessarily have to move it up, but if you want to be cautious and you're just a beginner and you don't want to take as many losses, this is very recommended because it often takes this low and then reverses. But okay, now still hasn't been taken. Okay, boom. Now, since it took both, but in this example, as soon as it takes this low is when you move your stop to break even. Once it takes this low, and then you target your next target, whatever. You feel me? But that's all for that. Just if it creates an intermediate swing high or swing low, then you want to move your stop to break even to that point. Let me go a little bit more into my stop loss. Okay, stop loss. Let me go back to my trade from earlier. Remember, a hard stop loss. Hard stop loss is how I enter. Hard stop loss. Is how I do not enter. I do not enter off a hard stop loss. I do not enter off of a. Let's see if I could. Oh, here we go. Okay. So this is not a bad entry right here. It violated both these gaps. Pretty good, nice V-shaped recovery. You can see it violated both these gaps, right? Boom. Okay. Let's say I entered here with no context. I entered here. Stop to break even is right here. I want to target this liquidity up here. Target this liquidity up here. Right? Okay, boom. Now my stop loss. I don't have a stop loss here like a bot just waiting to get fucking smacked, right? That's not how my shit works. My shit works is I measure the amount of points to see, like, let's say, because the candle should usually not close I don't know why it keeps doing that. The candle should usually not close much farther below the fair value gap. So I set my risk parameters based on a couple points below the inverse fair value gap. So let's say, okay, I'm gonna give it some room if it closes a little bit more below. So my stop loss in my head is around 937. So that's about a, how many point stop loss is that? You can calculate this using the order little drop box when it pops up, but 17 points. So if I'm risking 17 points, then I want to enter into about like 8 contracts. So I want to risk 8 contracts, right? Oh shit. Risk 8 contracts, and then, but I do not want to have my stop loss here. I do not want to just have a stop loss sitting here. I get rid of my stop loss because I know I'm only closing if it violates this inverse, if it comes back down. So I move my stop loss out the way, and so I'm only closing if it violates it. So I'm okay, still it's respecting it, still. Okay, still respecting it. As you can see, it hasn't closed below this inverse yet. And oftentimes what you'll see it do is it will do this and then reverse back up. And because it's just simply a signature in price, as you guys will come to notice, there's a lot of patterns within the market, obviously, because that's all day trading really is just recognizing patterns. And price usually respects the inverse if it's a good inverse. But in this example, you could see price still hasn't closed below. Now it finally closed below. So this is where you take your loss because it violated the inverse fair value gap. So then as at the candle close of this, you're like, okay, I'm done because my idea got invalidated because it violated the inverse fair value gap just like my entry had done. So I close my position and I take that $200 loss. Now if it had done something like this where it still hadn't closed below that box, and then it gave me a candle back up like this, I'm still in the trade because it oftentimes does this, as you guys will see with more screen time and more experience. The next candle sometimes will be like this, and they'll give you another entry back up. But now, since you guys just learned the intermediate term high that we form is a break-even point as well, now if it came back up, it formed an intermediate term high already on our entry. So once it takes this point, you immediately move your stop to break even, and you're more than likely than not to get your stop to break even hit, and you'll lose or make $0. If that makes sense. Any question, just hit me in the Discord. It might be a little confusing, but it should make some sort of sense. That should be it for the stop to break even stop loss video, soft stop loss. Yeah, that should be it. All right, I'm gonna catch y'all niggas.